The amount of time a person needs to achieve financial freedom depends on various individual and external factors, such as income level, expenses, financial habits, investments, and specific financial goals. Below, I provide a detailed analysis of the factors involved and the steps necessary to calculate the estimated time. What is financial freedom? Financial freedom is defined as the ability to cover all living expenses through passive income from investments, rentals, automated businesses, among others, without relying on an active job or salary. Factors that determine the time needed to achieve financial freedom. Income. Active income, salary, business, freelance work is the starting point. Increasing income allows you to save and invest more quickly. Strategies, professional specialization, promotions, entrepreneurship, or diversifying income sources. Expenses. Reducing expenses to the minimum necessary helps increase savings. Controlling unnecessary spending and adopting a frugal lifestyle can accelerate the process. Useful tools, budgets, expense tracking, and a savings mindset. Savings rate. The proportion of income saved and invested each month is key. A general rule, the higher your savings rate, the faster you'll achieve financial freedom. For example, 10% savings rate, it could take decades to achieve. 50% savings rate, you could achieve it in 15 to 20 years. 70% or higher savings rate, you could achieve it in 7 to 10 years. Investment returns. The returns on investments determine how much your wealth grows. Example, a diversified investment portfolio, stocks, bonds, real estate, with an average annual return of 6% to 8% can significantly accelerate the process. Compound interest plays an essential role. The earlier you start, the faster your assets grow. Financial freedom goal. Defining how much money you need to live comfortably is crucial. Common formula, 25 times your annual expenses, based on the 4% rule, which estimates you can withdraw 4% of your portfolio annually without depleting your capital. Example. Annual expenses, $20,000, you need $500,000. Annual expenses, $50,000, you need $1,250,000. Age and start time. The younger you start, the more time you have to leverage compound interest. Starting late is not an obstacle but requires a higher savings rate or more aggressive investments. Inflation. It is essential to consider how inflation erodes the value of money over time. Financial goals must be periodically adjusted to reflect inflation. Practical example, calculating the estimated time. Let's assume the following case. Net annual income, $50,000. Annual expenses, $30,000. Savings rate, 40%, $20,000 annually. Average annual investment return, 7%. Financial freedom goal, $750,000, 25 times the annual expenses of $30,000. Using a compound interest calculator, the estimated time would be years needed, approximately 18 to 20 years. This assumes that all savings are invested and generate compound returns and that there are no significant fluctuations in income or expenses. Practical strategies to accelerate the process. Automating savings. Set up automatic transfers to investment or savings accounts. Tools like budgeting apps help control expenses. Tax optimization. Maximize the use of tax-advantaged accounts, retirement plans, education savings accounts. Plan taxes to reduce the tax burden and increase available capital. Creating passive income. Common sources. Rental properties. Stock dividends. Bond interest. Royalties from books, music, or digital content. Example, a rental property generating $1,000 monthly net income contributes $12,000 annually to your passive income. Starting a business. Scalable businesses can generate considerable income if well managed. Example, online businesses, e-commerce, or franchises. Foundational pillars for financial freedom. Financial education, the foundation of success. Understand key concepts such as passive income, compound interest, investment diversification, and the importance of managing debt. Examples of books and resources. Rich Dad Poor Dad by Robert Kiyosaki. The Intelligent Investor by Benjamin Graham. Online resources like personal finance and investment courses. The cycle of saving, investing, and growing wealth. Saving is the first step, but it is not enough if the money isn't invested. Investing transforms savings into a tool that generates passive income. Compound returns are the main driver. Example, an initial investment of $10,000 with a 7% annual return will double in approximately 10 years, Rule of 72. The financial freedom formula. Based on determining how much money you need to live without actively working. Basic formula. Financial freedom goal equals annual expenses x 25. This is based on the 4% rule, which states you can withdraw 4% of your assets annually without depleting your portfolio. Comprehensive example of a financial freedom plan. Initial profile. Age, 30 years. Annual income, $60,000. Annual expenses, $30,000. Savings rate, 50%. Average annual investment return, 7%. Financial freedom goal, $750,000. Action plan. Annual savings, $30,000, 50% of income. Annual investment, all savings are invested. Time needed, in 17 years, the portfolio will reach $750,000 with a 7% compound return rate. The person would be 47 years old when achieving financial freedom. Accelerators. If income increases to $80,000 while maintaining expenses at $30,000, the time required decreases to 12 years. If investments yield an average return of 8%, the time decreases even further. Final reflection. Financial freedom is achievable for most people if they adopt a mindset of discipline and planning. While the timeline varies depending on individual circumstances, implementing strategies for saving, investing, and generating passive income can significantly reduce the time required. The process is not just about financial calculations, but also about mindset and priorities. Adapting these strategies to your personal situation will help you work toward an independent financial future where your time truly becomes your own.